6 dividend stocks at their 52-week lows. We're going to take a look at the historical performance of each company. We're going to jump into their dividend safety, looking at some very important financial metrics, and we're going to run through their valuation, getting to their individual intrinsic value and our acceptable buy price given our investor margin of safety. Jumping into the first company today, we have British American Tobacco. Now this has been hammered down 28% year to date, right there at the 52-week low, offering a yield of nearly 10%. Now, investors who had been holding this company over the last 10 years would be down 43%, and we do see its all-time high sitting around $73, $74 in the middle of 2017. Now, when we take a look at that dividend safety, we do see a borderline safe score, 65 billion market cap, so it is a large cap company. Now, in terms of recessionary metrics, for those that see a recession inbound, well, they increased their dividend during the 07-09 recession, positive 5% sales, which was above the average growth of companies in the S&P, and it did outperform the S&P with a negative 31% return versus the S&P's negative 55%. Now, dividend growth, it has been fairly slow. The last full year sitting around 1%. We're still waiting for the full year, but we can see that is below the 4% we advocate to beat on inflation. Last 5 years on average, though, you are locking in a 4% yield dividend growth increase, which is positive as you are not only keeping up with inflation, but you are also locking in a yield around 10%. Last 20 years as well, 10%, so that is nice to see. And we can see they are 2 years away from becoming a dividend aristocrat, which is whenever a company pays consecutive dividend increases for 25 years or more. Now, dividend yield theory, well, it states a company is undervalued when that current yield sits above the 5-year average. So we have our first sign of undervaluation. Likewise, forward PE 6 versus the 5-year average of 8. We have another sign of undervaluation. And we can see it is significantly below the consumer staples sector PE at 18.4. Now, it is important to note, just because a company is sitting at that 52-week low, it doesn't necessarily mean it is undervalued. Now, taking a look at the free cash flow, which is always what we focus on, earnings is susceptible to manipulation by management through accounting, so we focus on free cash flow below 60% for the majority of companies, although for particular companies we can increase it, like 85% for tobacco companies. Positive to note, for the majority of the last 10 years it has been below 80%, 85% as well. From 2018 it has been around that 50% mark, which is positive to see, with 2023 expected to be 51%. Now, in terms of the free cash flow per share, $1.95 in 2013, $4.32 in 2022. So it is increasing over the last 10 years. It isn't very consistent, but it is positive to note that it does move in the right direction. And it is always key to understand the type of companies you do invest in. Sales growth, it is a mixed bag. We do have that period of 2013 to 2015 where it was fairly poor, and then it had that period where it was very positive, but then we can see 2020 to 2021 flat, and do bear in mind, if they're not increasing by at least 3 to 4%, then they're not even keeping up with inflation, so in real terms it is decreasing. So numerically speaking, what we can see, the top line has nearly doubled over the last 10 years, from 15 billion to 28 billion. Shares outstanding, do note they do share issuances, so that your position as a shareholder is diluted over the last 10 years, moving from 1.91 billion shares outstanding to 2.27. ROIC, personally, 10% or more is what I tend to focus on in the companies I invest in. The reason for this, it means management are able to effectively allocate their capital. We can see, though, over the last few years it has been around like 8 to 9%, although do note 2023 is expected to come up to 10%, so that is positive to see. Both free cash flow margin and operating margin very, very strong, very consistent as well, above the minimums we look for on both of them, so that is a positive sign of the operations of the company. And the net debt to EBITDA, which does closely follow that dividend safety as well as showing us the strength of the balance sheet, shows us here the number of years it would take the company to pay off all of their debt net of cash on hand. 2022, it is below the 3 we look for. We do see it at 2.96, and it is positive to see that 2023 is expected to be even lower. So that is a positive sign for the dividend safety as well as that essential balance sheet score. Now, stock valuation model, typically on the channel, if you're a regular viewer, you know we run through every single model to get to the output, which is essentially the intrinsic value calculation, which is the average of these 4 models. So for British American Tobacco, we have an intrinsic value of $51. Now, with the current pricing at $29, what we normally do is 10%. We start off with that and we say that is applicable for companies that fit 3 criteria: wide moat, strong financial metrics, and good forward-looking data. Now, the margin of safety really depends on the investor's thesis and how well they do see the risks and the rewards for each individual company. 20% it would still be a buy for BTI. At 30%, again, still a buy. And this can pretty much go down to around 45%, which is around $1 shy. So pretty much for BTI, you are locking in on our estimates and judgments a 40 to 45% margin of safety. What do Wall Street say? Well, they believe there to be some nice upside, not as high as our intrinsic value, but around $38. So what we're saying right now for BTI, you are locking in around a 40% margin of safety with around 30% upside per Wall Street analysts. Moving on to the second company, we have CP, Canadian Pacific. Now, this is one of those that has many railway tracks. Year to date, however, they are down around 3%, a few dollars shy from their 52-week low. They do offer a yield of just below 1%, and investors who have been holding this company over the last 10 years would be up around 142%, so very positive, bearing in mind as well that doesn't include those dividends reinvested, and we can see its all-time high sits around $83, $84, which is $10 shy of the current trading price. Now, in terms of their metrics, well, dividend safety score sitting at 76, so it is safe. 68 billion market cap, so it is a large cap company. Recessionary metrics, well, in fact, they maintained the dividend during the recession. They didn't increase it, but they also didn't cut it. The average growth of companies in the S&P around minus 13%, but they did significantly underperform the S&P with a negative 64% return. Now, dividend growth, we can see here no growth since 2020. Over the last 5 years, though, there has been 12% increase year on year, and over the last 20 years, 11%. So we can see they currently have 0 years of consecutive increases to their dividend. Now, dividend yield theory, as always, we can see right now that it is roughly around that 5-year average. So you could argue based on dividend yield theory, it is reasonably valued / slightly overvalued. And we can see the forward PE fairly in line, sitting at 23 versus the 5-year average of 22. Now we can see the sector PE for industrials at 18.8, so again CP is slightly higher. And when we look at those free cash flow payouts, remember below 60% is my personal preference, and for the last 10 years it has in fact even been below 50%, with 2022 coming in at 27%, 2023 expected to be slightly higher. Now, free cash flow per share, it has gone from 82 cents in 2013 to 278, so it has increased fairly positively around 3 times. Again, we do note some inconsistencies. It isn't straight, consistent increases year on year, and do note 2023 is expected to be slightly lower. Now, sales growth, again, it is a bit of a mix here. We can see most years, though, between 4 to 7%. We do note 2 years, however, with negative growth. 2022, very positive, double-digit growth. 2023 expected again double-digit growth. So that is very nice to see. It is growing very strongly over the last few years. Now, total sales, $6 billion in 2013, 8.8 in 2022, and do note a very nice increase is expected in 2023 of $11 billion. Now, as always, we do love to see when companies do share buybacks, which Canadian Pacific have done from 2013 to 2021. As we can see, it has gone from 883 down to 683. However, do note the issuance here in 21-22, which does essentially correlate to the purchase of the Kansas City Southern. So therefore, we do see that large increase in their shares outstanding. Now, when we take a look at their ROIC, again, that does essentially become part of the reason why that has lowered. And even before then, we do see some very nice double-digit ROIC figures. And as always, that does give us faith in management and their ability to effectively allocate their capital. Operating margin, consistently very strong. In fact, it has increased over time from 2013. Same can be said about that free cash flow margin, with the last 2 years in the high 20s, looking very, very strong for any company that you'd want to invest in. Now, in terms of the net debt to EBITDA, we can see here 3, remember the maximum number of years we'd like in terms of them paying off all their debt net of cash on hand. Yes, it is above that in 4.39 in 2022, but do note it is expected to come down in 2023, with 2024 expected to come down even further. So we can see that their balance sheet is looking like it is going to get stronger over time. So that is positive to see. Now, in terms of the valuation model for Canadian Pacific, and as always, if you enjoy the content values being provided, do go ahead, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, current price sitting around $72.89. 10% is what we start off with, so you are getting a 10% margin of safety. You are also getting a 15% margin of safety, and if we move it to 20%, we can see it is short. So right now, based on our estimates for Canadian Pacific, you are getting a 15% margin of safety. And when we take a look at the Wall Street forecast, well, they see the price over the next 12 months roughly in line with our intrinsic value. So that is very positive to see. They are expecting around 15% upside. So based on the current estimates and judgments, you are, per our opinion, locking in a 15% margin of safety with around a 15% upside per Wall Street analysts. We then move on to the third company, which is Deere and Company, in the same industry as Caterpillar in the construction, and we see that this has been battered down 14% year to date, trading pretty much near its 52-week low, and does offer a yield slightly higher than Canadian Pacific at 1.62%. Now, if you had been holding this company, well, you would be up even better at 318%. We can see its all-time highs that it has hit around the $440 mark a few times. Now, in terms of some of their financial metrics, well, dividend safety score sitting at 83, very safe. Market cap, $105 billion. It is a mega cap company. Last recession, they maintained their dividend. They had below the average growth at 19.6% negative, and they also underperformed the S&P with a negative 65% return. One thing I love about this company, double-digit increases, 16% last full year, 14% last 5 years on average, and 13% over the last 20 years. That is some very, very nice consistency to see. And when we take a look at dividend yield theory, well, what we can see, a sign of undervaluation. Current yield sitting above at 1.62 versus 1.3, as well as that forward PE sitting just below the 5-year average at 12.9 versus 15.6. Now, when we take a look at the sector PE, again, significantly lower at 12.9. Now, free cash flow payout, it is important to look. We can see over the majority of the last few years, it has been, in fact, below 40%. Do note 2022, though, a bit of a red flag indicator. What this essentially shows is that the company paid out more in dividends than they generated in free cash flow. And it's always why I say we should focus on the free cash flow payout as opposed to the earnings, because for the same year in 2022, we would have seen the earnings and we would have said, oh, that looks really good at 18%. So something just to bear in mind. Free cash flow per share, $2.39 in 2014, $14.10 in 2023. Yes, it has a very, very strong increase over the last 10 years, but do also note the inconsistencies, the ups and downs throughout the last 10 years. Now, sales growth, very positive to see the last 3 years at double digits, but we can see the cyclical nature of the industry, where there are a few years of negative growth followed by positive, and so on and so on. Now, how does that look numerically speaking? Well, 36 billion of sales in 2014, 61 in 2023. And yes, we love it. Returning excess cash to our pockets, 366 million shares outstanding in 2014, 294 in 2023. So that is very positive to see, doing some nice share buybacks. Now, ROIC, it is above that 10% over the last 3 years. So that is nice to see, and I would like to see that continue over the foreseeable future. Operating margin, they did struggle for quite some time. Over the last 3 years, though, this has picked up. You could argue the cyclicality of the industry, so we may expect soon for this to go back lower than it currently is. And the same can be said for the free cash flow margin, although they too tend to struggle more on this than the operating margin. Net debt to EBITDA, though, we can see why that dividend is very safe. 2023 coming in at below 1, so they do have a very nice, strong balance sheet. Now, in terms of the valuation for John Deere, in fact, let's look at the intrinsic value. Remember, it is just the average. And if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of not only companies in your portfolio, but also your watch list, do go ahead and click on that pinned comment below and grab a copy. So margin of safety, we start off with 10%, it is still a buy. At 15%, it is still a buy. And at 20%, it isn't pretty much far off the current trading price, a few dollars shy. So we do believe for John Deere & Co, you are locking in around a 20% margin of safety at current prices. And even Wall Street believe the next 12 months will see some tremendous share price appreciation for DE, as we can see, nearly in line with our intrinsic value. So thus this does look to be very undervalued right there towards its 52-week lows. We then move on to the pharmaceutical company. We have BMY Bristol Myers down 30% year to date, right there at the 52-week low. One of the highest yields we've seen so far at 4.8%. And if you were holding this over the last 10 years, well, you would effectively be flat on your investment purely on share price. And we can see it has hit its 52, or in fact all-time high at around $80 at the back end of last year. Now, in terms of their metrics, that dividend does look safe with a score of 79, 102 billion market cap. It is a mega cap company. They also maintain their dividend during the recession, below average growth of companies, but interestingly, they did outperform the S&P with a negative 32% return. Very nice to see that dividend increase this year at 5.3%, purely because you are getting a fairly decent yield, as well as effectively an above inflation increase, which is above that 4% we always advocate on the channel. Last 5 years at 7%, although the last 3 years, or 20 years in fact, has been at 3%, so that has been slightly lower. They have also been increasing their dividends for the last 16 years, with 52 years of paying dividends without a reduction. Now, in terms of dividend yield theory, this one looks to be extremely undervalued at 4.77% versus that 5-year average, as well as the forward PE sitting comfortably below at 6.6 versus that 9.2 5-year. Now, sector PE, again for healthcare, much higher at 16.3. And when we take a look at the free cash flow payout, it is very, very nice to see that over the majority of the last 10 years, it has even in fact been below 50%. And 2023's results is showing that again at around 42%. So that dividend is very safe, and we can hopefully come to expect slightly larger increases over the next few years. 183 on the free cash flow per share in 2013, 561 in 2022. They are increasing that at a very nice rate, and we can see the last 12 months or trading 12 months looking likely that it will be fairly flat on 2022's performance. Sales growth, not the most growing company that we can see, although we do note that it is fairly inconsistent with a very large increase in that COVID year and looking flat in 2022, with 2023 expected to be negative. And when we look at that numerically, we can see very inconsistent and then a very strong jump in that COVID point. 16 billion in 2013, 46 in 2022. And on top of that, they do share issuances. We can see over the last 10 years, your position would have been diluted quite strongly from 1.66 billion in 2013 to 2.15 in 2022. ROIC, again, very, very fluctuating. The last 2 years, however, above 10%, with 2023 expected to be around that 12% mark. So that is fairly positive as long as that does continue. And we can see the operating margin for biotechs, we like to see around 25%. It is fluctuating around that point, although we do see a few years where it is significantly lower. And on the free cash flow margin, it has been over the last 6 years above that 20%, and 2023 expected to be as well. Net debt to EBITDA for biotechs, we like to see around 1.5, 22 at 1.55, 2023 expected to be slightly higher, but still not too far off that point. So that dividend is safe, and we do have faith in management and that balance sheet strength. Now, the valuation and for BMI is coming to on an intrinsic basis at $68, and we can see the current price at $50. So a 10% margin of safety would be a buy up to $61. A 20% margin of safety would still be a buy up to $55, and 25% essentially around that current trading price. So for Bristol Myers, you are looking, based on our estimates, a 25% margin of safety. And Wall Street also believe there to be some very strong upside of 30%. So in conclusion, for BMY, we are looking around a 25% margin of safety with 30% upside per Wall Street analysts. We then move on to the fifth stock, which is also in the pharmaceutical industry, which is Pfizer, down 44% year to date, right there at that 52-week low with a yield of nearly 6%. Now, if you have been holding this over the last 10 years, again, you would be fairly flat on your investment. We do see it hit its all-time high of around $60 at the back end of 2021. And when we take a look at the dividend safety, well, for a yield of nearly 6% at 75 is very positive to see. 163 billion mega cap company. And when we take a look at those recessionary metrics, they did in fact cut their dividend during the last recession, above the average growth, however still negative, and slightly performed better than the S&P with a negative 45% return versus the S&P's negative 55. Dividend growth, we are expecting an increase this year, although last year's was fairly poor at 2.5 below inflation. Last 5 years above at 5%, last 20 years above at 6%, which isn't too bad if you are locking in a fairly nice yield. And in terms of dividend yield theory, well, again, severely undervalued per this theory, 5.7% versus that 5-year average. And we see the forward PE roughly in line with the 5-year average. Sector P, however, slightly higher than BMI, and we can see the healthcare sitting there at 16.3. Now, in terms of free cash flow payout, well, yes, it has been pretty much below 60% for the majority of the last 10 years, but do note the last 12 months showing that it is likely to be well over 100% for 2023, meaning they may be paying out more in dividends than they are generating in free cash flow. So a little bit of a warning there. Free cash flow per share, well, $2.38 in 2013, $4.64 in 2022. So it has essentially nearly doubled over the last 10 years. But again, you do see that COVID years having a massive impact. Otherwise, before then, it has remained relatively flat. Likewise, again, the same story. Here we can see that with COVID, they did have a large increase in terms of their sales growth. But before that, it was pretty dire, as we see, relatively flat or decreasing. And we can see the actual effect COVID has had with their top line, in fact, doubling from 52 billion to 100 billion, with 2023 expected to be significantly lower. Shares outstanding, though, they do share buybacks from 6.9 billion to 5.73, so that is a positive to the investor. And ROIC, it is difficult to analyze this because before COVID they were sitting around that 8 to 12%, but after that it did increase fully, and we can see that post-COVID effect with that coming all the way down to 5% expected. Free cash flow margin and operating margin, again, very nice to see above the 12%, but 2023 it is expected to come down like a rocket from 2022's position, and the same can be said about the free cash flow margin, although it is still very, very strong in terms of their metrics. Net debt to EBITDA, this is where we see that dividend safety and balance sheet strength, 0.41 in 2022, still below the 3, and we can see again it is expected to increase quite significantly in 2023, but still below that maximum that we target. So in terms of the valuation for Pfizer, and don't forget, you can click on that pinned comment below so you can grab a copy of this model to run through companies of your own or even companies on your watch list. So an intrinsic value of around $38, $39, 10% margin of safety, it is a buy. 20% margin of safety, it's still a buy. And at 25%, it's pretty much right at the current price. So we do believe for Pfizer, you are locking in around a 25% margin of safety. And Wall Street believe, in fact, it is expected to go even higher than the intrinsic value we've calculated. So you are pretty much getting a 25% margin of safety with upside per Wall Street of over 30%. This now takes us to the sixth stock, which is one of the most disputed on the community, which is Medical Properties Trust, down 60% year to date, right there towards that 52-week low with a yield of over 12%. Now, if you have been holding this over the last 10 years, it wouldn't be one of your greatest investments, down 61%, with the all-time high sitting around $24 pre-COVID. Now, the dividend safety is around 920, so that is pretty unsafe. Market cap of just under $3 billion, so it is a mid-cap company. Now, recessionary metrics, they cut the dividend during the 07-09 crash. Recession sales above average growth, but significantly underperforming the S&P with a negative 76% return. Now, they have already cut the dividend once this year at negative 48%, although over the last 5 and 10 years on average, it has been increasing by 4%. Now, dividend yield theory, as we can see, the yield is significantly higher than the 5-year average, as well as the forward P to AFFO significantly lower than the 5-year average too. Now, when we look at the payout, typically for companies, we focus on the free cash flow, but for REITs, a lot more volatile, so we focus on the adjusted funds from operation, well below 95%, as we can see over the last few years, which is positive. 2023 expected 76%, so that is quite a positive sign. Free cash flow per share, again, for REITs, we will focus on the adjusted funds from operation per share. It has been increasing from 93 cents to $1.42, but again, not very consistently, and it is expected to drop in 2023 as well as 2024. Now, sales growth for REITs, 5-10% is what we like to see. And in fact, up to 2021, it did have that, as we can see. 22 a 1%, although no, 2023 is expected to be a negative increase from the prior year. And we can see here 250 million worth of sales in 2013, 1.58 billion in 2022, and 2023 again it is expected to drop. Shares outstanding, as always with the REITs, they do the opposite. They do issue equity, they do dilute your position. The reason is to fund their property acquisitions, as they do retain little of their internally generated cash flow after paying dividends. Some REITs, though, do dilute your position more than others. ROIC for REITs, 3 to 5% rather than the 10% typical, and it has had quite a very strong ROIC, but we do see it expected to drop down to 3% in 2023. Operating margin, very nice to see the consistency over the last 10 years, but again, similar to the other metrics, we are expecting a drop into 2023. And the net debt to EBITDA, yes, it is higher for medical building REITs at 6, and we can see it is increasing not only in 2023 but also in 2024 expected. So therefore, that dividend does look like it could be potentially cut in the future. And now when we jump into their valuation model, and as always with the majority of these videos we are running through, if you want to see the in-depth analysis, do check on the channel where we have run through the majority of all these companies in quite some detail. Intrinsic values coming to 1079. Now this is, in my personal opinion, quite a speculative stock, so I would never use 10% to start this off, but we can do for those that are interested. It is a buy up to 971. If we would start off with 40%, it is still a buy. At 50%, it's still a buy, and at 55%, pretty much near the current trading price. So it really does depend on the risk to reward ratio of the investor and how they believe this to perform over the next few months and years. Wall Street, well, they believe the share price to go up to $7.13, not as high as our intrinsic value, but they do still see quite some significant upside to this current stock, which has been battered continuously. Now, as always, do click on that pinned comment below if you do want to grab a copy of this valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list. If you've enjoyed today's episode, do smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And always put your comments in. I'm interested to see your thoughts on any of these stocks. Are you looking to buy any, looking to sell, or even if you have a bearish or bullish scenario on each one? As always, have a great day and catch you on the next episode. Take care.